Our next session is a panel discussion with 4 experts on the topic of Black, Scholes, Merton, and the financial, regulatory, and policy landscape. We've got Angelo Evangelou from Cboe, Peter Fisher from BlackRock, Debbie Lucas from MIT, and this is going to be moderated by our MIT's very own Ben Golub from BlackRock. Please join me in welcoming them.
Hey, Ben.
It's very nice to be here with everyone today for this retrospective conference. I have to confess, I was telling some of my friends where I was going, and I told them, well, it's about the Black, Scholes, Merton formula. And they say, what's that? And I explained it was sort of a mathematical formula, and they all chuckled. I guess it's not that common to get that excited about complex mathematical equations. But what the heck, I'm an MIT guy. I was excited. No, with derision. There are rare occasions when an idea arises that is so powerful that once it's in your head, you can never think about the world the same way. And in finance, there are perhaps only a few of these ideas, and certainly Black, Scholes, Merton is one of them. No one can think about options without thinking about Black, Scholes, Merton, and the logic is compelling, it's very powerful, it sort of works, and it's not the theory and the math and the empiricals all speak the same way. But even more interesting and powerful, I think, is that this is an idea that stretched beyond its immediate domain, which is options trading, and how one thinks about corporate finance, how one thinks about mortgage-backed securities, the whole creation of the various derivative markets really are based upon utilizing the logic and content that we see in Black, Scholes, Merton. One personal aha moment for myself is when it finally clicked in my mind about corporate debt being, in fact, put option and a default-free instrument. It was something I never would have thought of it on my own, and it came there and it clicked, and aha, I'm a wiser person for it. I can confess, though, that I'm still waiting for my aha moment on Ito's lemma. It hasn't happened yet. I was fortunate to also take that interesting class that Eric was talking about earlier with Fisher Black. I don't remember it quite as precisely as he did, but I do remember that there were very, very challenging questions, and you had no idea whether you were right or wrong. And in fact, sometimes everyone was wrong, and then he'd say, you guys are right. And you would take an exam, and it was like you didn't even have a clue as to what was going to happen. And put yourself in the mindset of, in my case, I was an undergraduate. You actually cared about your grades, and you have no idea what you're going to happening. And then the last day of class, he said, I like this class. You're all getting A's. True story. In terms of my professional activities, my engagement with Black, Scholes, Merton was not de minimis, although it was in a different form. When we set up BlackRock something in 1988, we had sort of a core thesis that there was a market where the options were not understood or properly priced. This is the mortgage-backed securities market, particularly some of the collateralized mortgage securities that were created where you had each of these tranches were different. And having been on the sell side of the business, selling it to people, realizing they had no idea what they were buying, the idea crossed our mind, if we could become an investment manager that understood them, we would have a leg up. And while there was no generalized closed form solution to the problem, there certainly were numerical approaches that could be taken. And for a little company, we invested quite a bit of our resources in developing the ability to value these mortgage-backed security options, or at least to figure out which side of the barn we're in, because sometimes the variation in what people paid for these things was incredible. And when we did this, this was a time when only the largest investment banks were able to do these types of calculations, and they were the sellers. Hence, you had sort of a tremendous asymmetry, and as we all know, asymmetry in knowledge in the financial world is a death sentence. And you know, some combination of both the methodologies and the existence of the Spark chip, which suddenly you could get mega flops, you know, floating point computations at a very, very different price point than the IBM platforms, which were used by others. And I think it's fair to say that certainly in its first 10 or 20 years of existence, BlackRock was highly dependent upon this capability, not just in terms of being able to invest and get investors to trust putting their money with BlackRock, but we were able to do this at massive scale and set up what is now the BlackRock Solution business, which at its core was about providing valuation of complex options which just couldn't be done easily elsewhere. My second professional engagement with the Black-Scholes Merton model was perhaps of a very different nature. BlackRock went public in 1999, and all of a sudden, the management could get stock options. And it was amazing how interested people became in that obscure formula. So not surprisingly, even the Luddites didn't chuckle. So I think with that, let me turn it over to our panel for opening remarks, and we can follow up with some questions. Angelo, do you want to start?
I'd be happy to, thank you. And I just want to say it's an honor to be here. Came in from Chicago. I'm one of the Cboe representatives. As you probably all know, we were originally called the Chicago Board Options Exchange. Today we're Cboe Global Markets. I've been at Cboe 25 years, so I started halfway in Cboe's existence, and it's really been an incredible journey. My two colleagues who spoke earlier today, Henry and Ariane, touched on how important Black-Scholes Merton has been to Cboe's evolution, the options industry's evolution, and spoke to just so many of the impressive and incredible developments that we've witnessed over the years. I thought I'd spend a moment to focus on the beginning and how the options market came about. Ariane referenced someone named Joe Sullivan earlier today. Joe Sullivan was the first president of Cboe, of the Chicago Board Options Exchange. And if you want the really comprehensive overview of how Cboe came to be, I would direct you to the Securities and Exchange Commission's Historical Society's website, because he wrote a paper that is housed on that website today that got into the details of how Cboe came about. I'm not going to go through it, but I'll touch on just a few of the high points because they're interesting, and it's a really great way to just see how far we've come. So in the late 60s, the Chicago Board of Trade, members of the Chicago Board of Trade, decided to undertake an exploration of should we be developing, let's explore development of a marketplace for standardized listed option contracts on single name stocks. Joe Sullivan was recruited to lead that effort. And a lot of study and work was undertaken, and they obviously realized that there were two key constituencies they needed to work with. One was customers, potential customers for the product, and two, of course, was regulators. You needed the regulatory buy-in to make the market happen, to get those approvals. And as Joe tells it, there was after a healthy amount of work, there was a key meeting in January of 1969 where they traveled, a contingent from Chicago traveled to Washington to make the pitch. And it wasn't really well received. Two of the quotes that he mentioned that they got back were insurmountable obstacles and don't waste another nickel on this. Amazingly, they were not deterred, and they decided to keep working on the project. And a credit to the folks at the SEC, they remained open-minded, notwithstanding their original feedback, and they were willing to keep hearing more about this potential marketplace. That bore fruit in October of 1971, when the folks in Chicago got word that if you build it properly, we may be willing to greenlight the effort. That in turn led to a lot of operational work, a lot of legal work, which then in turn brings us to February of 1972, when Chicago Board Options Exchange became a legal entity. And so now it's real, and the hiring is underway, and the infrastructure is being put together. And it all culminates in 1973, as you know. The exact date was April 26, 1973, and that's when Cboe launched. It launched with call options on 16 stocks. And at the end of that first trading day, 911 contracts had traded. It was a successful day. Things got even better for Cboe because, as everyone here knows, that same year, Black Scholes Merton emerged, and it was greatly embraced by the folks behind the exchange effort. And in his write-up, Joe Sullivan mentions that market makers that leveraged the methodology, the model, fared better than those that didn't. And as my colleagues mentioned earlier today, it obviously just played a major role in informing and improving price discovery on our market, liquidity on our market, and efficiency in our market. So tremendous development that year. At the end of 1973, after having added a few more stocks, the average daily volume on Cboe was 10,000 contracts. Strong year. Let's fast forward to today. Now, we've done a few things since then. We've added puts and a few other products, and so there's a little bit more going on under the Cboe umbrella. We now have 17 national securities exchanges that trade options in the United States. But impressively, the average daily volume today, at least in recent weeks, is, I want to say, around 44 million contracts that trade in the United States in listed option marketplace. So it's truly impressive. Option markets are emerging in other jurisdictions. Cboe is behind one in Europe, but they're in a lot of places. So it's just a magnificent development, and it really just highlights what can happen and the possibilities when industry, academia, and the government work together, collaborate, and I think that the best years are still ahead. So it's been a really incredible journey for Cboe, and we owe a lot to the model, but we're really looking forward to even brighter days ahead. Thank you.
Thank
Peter? Me next? Debbie next?
Oh.
Me. You want me to go next? You go first.
Okay, he's ceding the floor to me. So I wanted to start with a personal reflection, which is, I know many of you are MIT grads and learned about options from the masters, and I guess I wanted to express my gratitude to the masters. One, because John Cox seeded me his course a few years ago, so every year I have the privilege of teaching a new generation of MIT students about futures and options and fixed income and derivatives. And so, I mean, you can't imagine a better course to teach. And it's actually a huge responsibility, because you're just trying to get people to appreciate the power of these ideas that we've been talking about today. So I appreciate the challenge. It's a big responsibility, but maybe what I appreciate most is how much clearer my own thinking is, because every year I go back and I look at what seem to be, once you've looked at them enough times, pretty straightforward formulas, pretty straightforward ideas, but the subtlety is, just amazing. So I guess I just want to express that gratitude. And then I'm going to turn to my main topic, which, as Jonathan Parker anticipated last night, I would start by saying that, in fact, governments are the world's largest financial institutions, and they're also by far the biggest writers of contingent claims. And if you go back to the early days of Black, Scholes, Merton, in fact, one of the first applications was by Bob Merton applying these insights to deposit insurance, because he quickly realized that credit risk is a put option. And of course, there's a lot of put options written on the government. And so just developed a very beautiful model on valuing deposit insurance. And really the message was powerful and simple. And it's that the value of these guarantees in terms of expected payouts is a tiny fraction of their value. And why is that? Well, it's because the guarantees are always called upon in the worst possible states of the world, and that bad tail that we've been talking about. So following Bob's paper, Bob's students actually built on those ideas in the 1980s and 1990s, and there was a really nice body of work that was developed on valuing pension insurance and crop insurance and various other government guarantees. And some of that work is still continuing. I guess I want to advertise tomorrow, the Golub Center for Finance and Policy is having a conference that is going to touch on some of these issues. I'll advertise that Andrew Lowe is going to apply some of these ideas to systemic risk. Bob Pindyke, who I think couldn't be here today, is going to be talking about applications to thinking about climate risk. So it should be very interesting. In terms of my own background, my own proudest achievement in life really to date was to be given permission to start a financial analysis division at the Congressional Budget Office shortly after the global financial crisis. And I'm proud of it because it is a place in the government that's demonstrating that we can do more than just say these obligations are enormous. We can actually try to measure them and try to get that information to policymakers. Well, so clearly there is enormous power, for better or worse, in being able to redistribute enormous amounts of risk using contingent claims. And in recent decades, governments of developed countries seem to have become more and more comfortable with wielding that power at an ever larger scale. Just to give an example, central banks have become more and more in the business of writing options. During the GFC, actually, the Federal Reserve System, in some sense, opened themselves up to unlimited liability because some of those facilities weren't even capped. Presumably, they wouldn't have gone that far, but it was very hard to imagine how much potential liability was out there. We saw a repeat of that during the pandemic. Not only were those central bank facilities reopened, but countries all over the world, particularly developed countries, provided trillions of dollars of credit guarantees, forbearance on government loans. So there was a huge amount of exposure. So there's good and bad news, both in the GFC and the pandemic episodes. The good news is pretty obvious. Government losses were modest. The public was spared a large tax bill. And maybe more fundamentally, those guarantees helped restore the economy more quickly, shortened the recession. So there really was value added to redistributing that risk. So you might wonder, what's the bad news? Well, I think the bad news is that there's been nothing to disabuse governments of the notion that the guarantees are a cheap way of achieving their policy goals. And the other shoe has yet to drop, and maybe it won't, but it's hard to imagine that we can depend on that forever. I was thinking as I was thinking about the conversation today, we have the P measure and the Q measure, and P goes to 0, but Q goes to 1. So, it's a very expensive risk over time. Will we ever see it in the P measure? I hope not, but if we do, not good. So the fact is that the governments really essentially ignore the insights of Black, Scholes, Merton. So I started out trying to be positive, but now I'm going to slip back into my negative but hope for the future mode. So governments basically treat these guarantees as free or nearly so. And of course, like any resource that's underpriced, risk-bearing capacity of the government is going to be overused. A very fundamental question is, well, many of us in this room, most of I would say in this room, completely recognize this. So why does this situation persist? I think there's a lot of reasons for it, but just to point to one thing is that the fact that governments operate on a cash accounting mindset is really a surprisingly big hurdle to overcome. And I'm going to take the liberty, I wanted to go before Peter so I could say this before he did. This is a quote from Peter, which he once famously said, "The federal government is like a giant insurance company with a small side business in defense." And then he followed that up by saying, "And an insurance company that operates on a cash basis is a disaster waiting to happen." So I think that's really a fantastic quote. Okay, so let me just make two final points. I'll do it quickly. It's changing gears a little bit. Not only does the government write a lot of put options, but it's also has an enormous footprint in the design of financial products. Now let me turn to the United States, for example. So think about consumer financial products, student loans, mortgages, reverse mortgages, Social Security, government health insurance. So in all these markets, the federal government is dominant. And if you think about each of those products, they are loaded with embedded options. So certainly some of those embedded options enhance value, but I think just as clearly, a lot of these embedded options reduce value. Why do they reduce value? They make the products very illiquid. They make it very hard for consumers to understand what they should do. Should I prepay my mortgage? Should I not? And in fact, I would argue that there's a large transfer of value from less sophisticated consumers to more sophisticated consumers, because the more sophisticated consumers can exercise those options more efficiently. So, a case in point is the 30-year prepayable nominal mortgage. Some people would say that's as American as apple pie, but I'm sure Peter knows where it came from. It was invented by HUD. And in fact, no other country has 30-year nominal prepayable without penalty fixed rate mortgages. You could also describe it as a toxic derivative, that's so hard to price. It's made perhaps the benefits that Ben found for BlackRock. I'm very sympathetic to the benefits, but it's not necessarily a benefit to society as a whole. So all of this is to say that governments need to think more carefully about how they construct products and the options that they put into those products, because it really has enormous effects on social welfare. And whereas when the private sector invents a bad product, it tends to get competed away by a better product. But government products are very persistent. If you put a big subsidy on a product, it's going to persist even if it's not efficient. So there's a kind of a stickiness to all of this. Okay, last point is just that, and this is kind of the other side of the same coin, is that another thing governments do is they sometimes buy options from the private sector. And this is another situation where I think the government usually comes out behind. So an example of that is, for instance, in the mortgage market post-financial crisis, the US government decided, well, Fannie Mae and Freddie Mac should sell some credit risk to the private sector. But the way that market is structured, some research with Ed Golding here showed that actually very little risk is transferred at a fairly high price. So it's another situation where the government's lack of sophistication about options is really quite costly and not very transparent. So that all sounds quite negative, but I'm actually optimistic that there's a lot to do, and hopefully some of the people in this room will take it upon themselves to work on these problems. Thanks.
So Peter, now you get a chance to say something else quotable.
I don't know if it's as quotable as that. After I gave that talk, a friend worked in the Clinton administration called me up and offered me a job because they were so convinced I'd be fired. having announced the federal government was a disaster waiting to happen. Anyway, it's a real honor to be here and a pleasure, and great to have Debbie go first and do the heavy lifting on the problem of the government's interference in financial markets through not knowing what it's doing when it's pricing options. But I'll come back to that in a moment. It is not generally recognized that corporate liabilities other than warrants may be viewed as options. That sentence in the 1973 paper, I don't recall when I read. But when I reread it, it struck me as a perfect summary of the financial crisis of 2008, which Andrew asked me to reflect on, because it embeds both that it's not generally recognized, the problem of real options, that there's a whole part of the world that doesn't see the options that are embedded everywhere, and then there's part of the world that does see them, that does recognize them, and then they can apply the formulas and figure out. And as Ben said, when you have an information asymmetry, you have a problem. And when we systematically create these asymmetries, as we tend to, because of government jumping in, we create too many free options. Someone is accumulating them and someone is writing them and doesn't know they're writing them. And so that struck me as a good metaphor for the 2008 crisis and perhaps even for systemic risk, but I'll see what Andrew says tomorrow. So we can think of 2008, the structured note that the retail investor buys, not knowing that it's contingent on the solvency of Icelandic banks, and they've just written a put to Lehman Brothers. Even the mortgage banker who is underwriting mortgages in 2006 doesn't really recognize they wrote a put option to the homeowner to mail the keys once equity is severely negative enough. They just didn't know they wrote that option, and they certainly didn't price for it accordingly. And so it's all this about this asymmetry of who can see that the options are accumulating and getting written and who can't. And that's a game we play on Wall Street all day long, intramurally, and then we play it with the government. And that seems to be, to my current way of thinking, where a lot of systemic risk comes from in our financial system, particularly our American financial system, maybe more so than others. So I just thought that's my reflection, but I'm now going to take a license with this audience to offer a speculation or a conjecture. The only case I know of the Fed writing actual options was what I did in the fall of 1999, when there was a risk premium in the term funding market because of the Y2K scare. And that was tightening monetary policy more than Chairman Greenspan and the Fed wanted. We were trying to cool the economy down. We were trying to tighten, but that was way too much, this special premium coming in around Y2K. And the obvious thing to do was flood the market with bank reserves, which was the opposite of what we wanted to do because we were trying to tighten a little bit. And so Greenspan let me write options on repo to finance across the year end. And we were able, using our off-balance sheet, to change asset prices without changing our balance sheet. And I just, my conjecture is, I wonder what would have happened after 2008 and 9 if my successors had tried a little harder and did not decide they had to flood the banking system with reserves and purchase vast quantities of assets, but had operated in the options market instead. Maybe we would still have a money market today, which we don't. I'm going to stop there and see what comments and questions the audience wants to throw at us, or Ben, you want to throw at us.
Okay, well, let's hear first from Angelo. The Cboe operates in a highly regulated environment. Can you tell us what policymakers are focused on as it relates to listed derivatives?
Sure. So I think what's been discussed are considerations the government maybe should think through, haven't, and the implications there. What I can tell you is as someone who interfaces with policymakers, I can tell you what the folks that I work with, what they do spend their time on, as it relates at least to the listed option market. Predictably, it falls entirely under the umbrella of investor protection, but the focus is on distinct areas. So one is market structure. So we see that a lot. We see this playing out today as it relates to equity market structure. The SEC has proposed some really transformative reforms. It has historically been the case that reforms that are adopted in the equity market ultimately get foisted on the option market after some time has passed. That's not happening with as much frequency, which is a good thing because they're very different. It's important for policymakers to understand that. The option market is a quote-driven market. The equity market's an order-driven market. But nevertheless, market structure is something that gets a hard look a lot. So as it relates to the option market, fees, whether it's fee levels or fee constructs, are always under review. Auctions, just the way auctions are structured and the way they play out on different market centers, an area of great interest, and things like best execution requirements of broker-dealers also get a look, which touches on conflict of interest. That's another area of focus. We saw with in the digital asset space with FTX, there was a lot of tension after the fact around conflicts of interest, and so market infrastructure is definitely under the microscope right now. Should market centers be affiliated with broker dealers, with FCMs? Should they be, should clearing be separate? That's all getting a look right now. Other area that we've touched on throughout the day is retail. So retail utilization of listed option contracts. That's something that policymakers are focused on. I'll give you two examples. Last year, FINRA put out a request for comment, wondering if we need an overhaul of how broker-dealers onboard retail investors or permission them to trade options. That request got, I think, a record number of responses, mostly negative on the concept of imposing some sort of reform, but it's still something to watch. And then we've even seen in Congress, I saw a discussion draft bill that was floated around the Financial Services Committee in the last Congress that it was pretty interesting. The idea was to require broker-dealers before they permission a new retail investor, before they permission them to trade options, to show them the percent of that broker-dealer's customers that trade options that have lost money trading options. They didn't quantify, or explain what losing means. So, presumably if someone had a protective put and the stock really didn't move, I guess they lost money on that put, but they probably got out of the put what they wanted. So, it raised a lot of questions. There weren't a lot of answers, but again, retail participation is something that's getting a lot of attention. And then risk, which we've talked about, that's obviously an area. It plays out a lot in terms of capital requirements for clearing firms, et cetera. So, the agencies that I work with at least are, very engaged, but it's really more from, investor protection perspective.
Thank you. Debbie, you devoted a major portion of your academic life to applying modern finance theory to the public sector. Can you identify some of the most impactful cases at applying BSM, as well as some of the remaining most intractable cases?
Yeah, so I wish that applying BSM would solve the really fundamental problems. As I alluded to before, there's been very good work done by various people on valuing all kinds of government guarantees. And I think something that some people mentioned was kind of the government doesn't understand. And I don't like that turn of phrase because I think there's lots of people in the government who do understand, Peter will nod his head on this, and they might understand, but they have no incentive to do anything about it, either because the status quo serves their goals, or just because it would be very costly to try to change the rules. So I guess, I mean, what I really want to say is there's very good work that gets done. It's a little bit sad for me that this young generation of researchers haven't been as engaged in these problems as I would like to see. So I think one thing that I know that my center is trying to do is get more people engaged in trying to apply models like BSM. But the more fundamental thing that remains to be done is infrastructure change within government. So this sounds a bit nerdy, but I really think that if governments made one major rule change, which would be to impose the same accounting standards on themselves as they impose on the financial system, the amount of the increase in the amount of transparency would be transformational, because we would just be able to see things that we can measure, we could measure, but we don't. But, you know, and I think I would say that the way I've spent my career is to try to demonstrate by using BSM derivative-like things to say, no, look, you can do it, and let's look for a way to make it easier to do that. It doesn't have to be the perfect option pricing formula. We just have to have a sense of the magnitude of the costs. And we can do, and you know, that was by way of demonstrating what's possible. But what I've realized over the years is what it's really going to take is some brave soul, some head of the IMF or head of the Federal Reserve System or head of the ECB has to decide that it's important to change the availability of this information, to just start to change the way people more broadly understand it. So that, you know, that's what I think really remains to be done. And it's not, so it isn't more measurements or more cost estimates, because the problem with the public sector is that most things are invisible. Well, let me back up just one more thing. So I was very involved with the Congressional Budget Office, and there's a lot of wisdom that you learn from being at a budget agency. But one thing is a lot of numbers that the government produces, and certainly what academics produce, they don't matter because they're not focal. But the numbers that are focal are the budget numbers. So in the context of these guarantees, if guarantees have a zero upfront cost in the budget process, they really are free from the point of view of policymakers. So simply getting a cost of those guarantees into the budget process, which is part of this infrastructure of building up transparency about value, would just have, you know, would have a lot of power. So, too long an answer to your question.
I mean, the issue is sometimes the truth is politically inconvenient. And, you know, whether it be Black-Scholes model evaluation or the impact of climate change, and why would you ever write a mortgage in Miami Beach? The answers are unpleasant. So as much as we like to hope that providing wisdom and facts would solve all the problems, I think the people who know damn well, most of them do, perhaps not the consumers, but certainly at the governmental level.
Well, can I jump in there, Ben, maybe tell a funny story and a sad story? So Debbie's heard me say this. My first assignment as Undersecretary of the Treasury was to persuade Congress not to enact a loan guarantee after 9/11 for the airline industry. And my second assignment was to implement the loan guarantee program that Congress enacted. They knew just what they were doing. Congress knew exactly what they were doing. Now, but the sad story is, and no one will prove this, sir, but as an Undersecretary of the Treasury, it came to my attention that the changes to the bankruptcy code that made it harder for student loans to be defaulted on was inspired by a group of people who wanted the government to be able to write more student loans and get around the credit scoring that implied a cost. Because if you couldn't lose them in bankruptcy, there would be no cost. So we've created a generation of debt peons in order to create a generation of debt peons. So they know exactly what they're doing deep inside of Washington.
So with that, between BSM and what you've learned about the GFC, what are what are the lessons that we have not yet learned about systemic risk management?
Well, I think the lesson that worries me the most is the quest of the bank regulators to find the perfect number for capital. Like there's a right number out there. In part out of, as many people like to say, out of physics envy or out of Merton and Scholes envy, that they're going to go look for this right answer when they can't find the options. That is, that they can't find all the contingent exposures. And one of my mentors at the Fed 30 years ago said, why are we writing a capital accord before we've gotten accounting standards better organized? It really was cart completely before the horse to try to say, let's come up with the right capital number. So that's a lesson we've got to go back and learn over again to get the balance sheet and off-balance sheet accounting right before you try to spend 30 years writing capital rules.
All right, so we have a little bit of time, and we're open for questions.
My quick question is, I seem to recall at some point that you had to calculate the value of the guarantees. Some of the office of the
Yes, the CBO, no, and
Yeah.
this was an effort to get
that was
around
all
it.
supposed to is
Yeah,
that
no,
no
so-
longer happening?
It's happening. So let me tell you, so the issue is that they don't use Black-Scholes Merton. The U.S. does better than most other countries, but it's still terrible because what they do is they projected losses, but they discount everything at Treasury rates. So there's no risk adjustment. So there's no appreciation of the tail risk. And for instance, there were many years where I know from talking to people at the Department of Education that they were losing money hand over fist on student loans, and yet they were still treating loans as adding value in the budget. In other words, students' loans were reducing the budget deficit on paper, even while they were losing money hand over fist. And of course, they're hugely systematically risky because the default rates go way up in a recession. So, but I guess you gave me this opening. So the group, thanks to Doug Elmendorf, who's now the dean of the Kennedy School, let me come back to CBO to start a group that does the only fair value estimation routinely that I know of in the federal government. And that's why I mentioned earlier the focality of the budget process. So whereas CBO, upon request, does fair value estimates, the official law that governs the budget says, thou shalt discount at Treasury rates. I mean, there's no latitude. Like, you cannot risk adjust on these credit programs. It's under the law. It's called the Federal Credit Reform Act of 1990. So, you're kind of stuck with that. And for a number of years, I kind of banged my head against that wall, hoped that some congressman somewhere, there was a bill that made its way through the House, but not through the Senate. So, this is what I mean. There needs to be these fundamental structural accounting reforms that are not easy to have happen. So it's not a matter of people not knowing Black-Scholes or the value is high, but there's these really institutional barriers to change, which might be boring to hear about, but they're really fundamental.
Efficacy is the programs as well.
Question for Angelo. The question I had was, what are your thoughts about when we are going to see real long-term options like a 20-year option or 25-year option? Just to give some context, for example, a very young person saving for retirement who has a very small amount of money in their savings, but yet can bear a lot more market risk than somebody older, can build up retirement savings quite quickly compared to just buying equities through using options. And if they are able to build that kind of wealth in their middle ages, they can de-risk rather quickly, then have to bear the market risk till very late in their retirement.
I don't have an answer for you. We do have we're unique from an exchange standpoint in that, innovations are really important part of our offering, and we have an entire department that's focused on product development. We have LEAP options, but that doesn't seem suitable for what you're asking or sufficient. I would defer to my colleagues who maybe could connect with you offline on that. But obviously, every product that we bring to market involves an assessment of customer demand and of the viability of market makers to properly put up a two-sided bid ask. So I don't have an answer.
One of the current topics, of course, this year that's gotten a lot of attention is some rather unanticipated bank failures. Given that there have been some surprises, Silicon Valley Bank and a number of others, if you were going to design a more optimal bank regulatory environment, I'd be very curious to hear about what some of the components might be and how that might be constrained by, shall we say, the political class realities of Washington these days.
Debbie, you want to take that?
Let Peter go first.
I'll try. There are lots of things. I think several people have written about this in the last several months, that capital just doesn't help you in a bank run. And so capital is just not the answer to all kinds of supervisory problems of the banking system. And yet we have a bank supervisory apparatus who were wedded to that view that capital is the answer. And whether it's, as we were reminded, Rudy Dornbusch's insight about time, that takes longer and then happens faster, or the bank examiner who taught me banks are wounded on the asset side but die on the liability side. It's as if the supervisors have forgotten half of their playbook. So you've got to go back and remember your playbook from before, when you put all your intellectual resources into capital. That would be my simple recommendation.
So I'll agree and disagree.
I don't mean capital's unimportant. I mean, it doesn't solve that problem.
I just want to say that I think capital requirements have been largely directed at credit risk, but banks have all kinds of risk, and this was an interest rate risk episode. And the irony is that there's nothing easier to quantify than interest rate risk and whether banks have hedged it. So I actually think that capital requirements should be linked to interest rate risk, not because it would be the solution to all runs, but because it would provide more of an incentive for banks to hedge against that risk. And in fact, I think a lot of people responded to what happened by saying, well, the supervisors weren't doing their job, but it wasn't the supervisor's job to tell banks to hedge interest rate risk. I mean, there should be rules, and then the banks can respond to those rules. So I really would like to see a more integrative capital framework that was based on the kind of objective modeling that we've been talking about at this conference.
I am curious to get a sense of whether you think the Defense Department could use options thinking. They've used game theory a lot in the Cold War, and they have a history of innovation in DARPA. But I think that the war in Ukraine has demonstrated that finance and the cost of weapon systems and innovation is full of options in terms of how do you respond with limited resources to a monolithic enemy. So I'd be curious as to how you think the US defense budget might change from the traditional spending patterns to a more flexible system with more options.
We're both passing the question off to each other. It's a great question, yeah.
It's a great question. I'm afraid my pessimism will come back to, you have to go to the Senate Appropriations Committee and see how they want to respond.
I was going to say too, yeah. Yeah, I mean, right.
That's where it'll flow back to, unfortunately.
Yeah, it's hard for the government to have optionality in their decision making. And that's a huge difference between government and the private sector, which is there's so many constraints, budgetary constraints. And I think it's interesting because in the United States, we're very suspicious of government. And so we don't give government a lot of latitude. And so we have rather lousy government. I mean, I think in the past, for instance, France gave their bureaucrats more leeway. And I've been told they did a better job, although that leeway might no longer be there. But I mean, it's much more difficult in government.
I'll tell you a story. When I went from the Fed to the Treasury, I had to come over from OMB to explain to me federal budgeting. He said, you don't get it. Congress gives you green money for green projects, and it expires on September 30th. And they give you blue money for blue projects, and you don't get to change. And you know, I had a budget at the Fed, I had a capital budget, I had an expense budget. I could just do what I wanted, you know, unless my boss called me out. But when you get appropriated funding, it's really different. So you'd have to get the options embedded in the appropriation. And I don't think the senator from state X wants money diverted from his missile program to a naval program in some other state. That, I'm afraid, is going to be the problem. Hate to end on that difficult note. We got a different question.
Hi, thanks for a great panel. I have a question for Professor Lucas, which is on, kind of an opaque market around long-term contingent claims, which is on the longevity risk transfer. And just wondering if you could comment on kind of what you've seen over the past 10 years, both in the private and public sector around longevity risk. And, I really like your insurance analogy. And the Fed in the spring put out a really interesting paper called Are U.S. Life Insurers the New Shadow Banks? And it talks a lot about variable annuities, being transferred to private equity holdings and other risk transfer. And so just curious to hear your thoughts on that and any options, analogies.
Yeah, well, thank you. That's an important set of issues. And what immediately jumped to my mind was just to say that, in fact, we need to create institutions to deal with longevity risk that make sense. So, Social Security will crash at some point, and in reforming that system in order to bring it back into balance is, in fact, one of the things that needs to be considered is how much longevity risk is there and how much should it be shared between retirees and the government and between richer and poorer retirees. So there's all these issues about risk sharing that are very important. I think they get discussed in academic circles. Some of it permeates to the government, maybe not enough. I actually think Peter will have a good BlackRock perspective because you've been thinking about retirement systems around the world and must be thinking about longevity risk.
Well, yes, we have been. I have been, and it's the great unanswered wrinkle when you layer it on top of the accumulation problem. I mean, you have to put the two together. What's the lump of capital? How are you going to pay it out? And I think most of the solutions that I think are intriguing are buried inside the more sophisticated national pension schemes like the Nordics, where they're actually not DB pensions, even though they look like it. So you can change, the cost of the guarantee is the double cost of uncertain life expectancy and a fixed income return. And that actually is negated. It's not really what's going on because you can adjust downward the benefit. And then you got the systematic longevity risk the pension scheme is left with. And the question is, how are we going to deal with that? Idiosyncratic comes out in the wash. And we don't really have a market in that. We have it's like the interest rate swap market in its infancy. It's just people meeting and they do a transaction, but it's not a price discovery market, is one of the problems with longevity risk when you pool it up. And so that's the unexplored frontier, is systematic transfer of systematic longevity risk. Can you make a market in that? And I've talked to a lot of the more sophisticated reinsurance companies, and they make bets on it, but then if they don't like the data, then they don't bet on it. Right? It's very simple. They just and so it's not a market that works. There's not someone on the other side, which I think is the problem with 20 and 30-year options. Someone has to be on the other side of them.
And maybe on a more positive note, we're talking about longevity risk, and I think everyone is thinking the risk that people live longer, but that's actually upside risk, not downside risk if we manage it well. So I think the more sophisticated policy thinking is how do we make work more flexible, basically creating real options for people to stay in the workforce longer, reduced effort. So I think, again, options thinking is very useful and an important innovation in policy.
Well, I want to thank the panelists for their remarks and the audience for your engagement.
Yes.
Thank you.
Thank you.